Watch a live chart of the precious metals market, and you'll see a distinct pattern. Gold might edge up a steady 0.5%, while in the exact same window, silver launches upward by 2.5%. That restless, aggressive asset is XAGUSD, the ticker symbol for silver priced against the US dollar. In finance, traders call this the high beta cousin to gold. Silver's ferocity comes down to scale. The global silver market is remarkably small compared to massive gold. Inject equal capital into both. Gold barely ripples, but that identical sum hitting silver creates aggressive, volatile intraday waves. That speed makes silver highly attractive for traders looking for large percentage swings, but trading it requires throwing out the standard Forex playbook. To survive this high-octane price action, you have to understand the two deeply opposed economic forces constantly tearing silver in different directions. First, look at the symbol itself. XAG follows the ISO 4217 standard. The X denotes a non-national asset, and AG stands for argentum, the Latin word for silver. While central banks hold gold as a purely monetary safe haven, silver operates with a split personality. Only half of silver's identity is tied to being a precious metal. The other 50% of global demand comes strictly from heavy industrial manufacturing. Silver happens to be the best electrical conductor on Earth. That physical property makes it an indispensable infrastructure component for the global shift toward green energy, especially in the production of solar panels. It is also a vital, irreplaceable raw material required to build the circuitry and batteries inside electric vehicles, and you will find it layered inside the printed circuit boards of almost every high-end consumer electronic device on the market. Because it is actively consumed by factories, silver prices are tightly correlated with economic indicators like the ISM Manufacturing PMI, which tracks the monthly health of the industrial sector. This dual nature explains the wild price swings. XAGUSD catches a bid as a safe haven when geopolitical tensions rise, but it also accelerates like raw copper when the global economy is booming. Pricing that volatility starts with understanding the unit of measurement. XAGUSD is priced in troy ounces, which equal roughly 31.1 grams. If you misunderstand this baseline weight, your entire risk management formula fails. Many intermediate traders experience immediate math shock when they open a silver position. Unlike standard Forex, one standard silver lot represents a massive 5,000 ounces. If you buy a lot at $28 and the price moves just 10 cents higher, you instantly have a $500 shift in your account. Because a single gap in price can violently swing your equity, brokers actively enforce safety mechanisms. You might trade the euro with 1 to 500 leverage, but brokers routinely cap silver leverage much lower to protect your margin. You also cannot rely on tight Forex stop losses. The intraday swings will easily sweep narrow stops. A common practice is using a 2x multiplier on the average true range, giving the trade actual breathing room. Adapting to these heavier contract sizes and wider margin requirements is mandatory. Otherwise, a minor sudden dip in market liquidity will wipe out your position before the real trend even begins. Before looking at a silver candlestick chart, you have to check the broader macroeconomic weather. XAGUSD operates on a strict inverse relationship with the US dollar index, commonly known to traders as the DXY. Because silver is priced in dollars globally, a surging US dollar makes the physical metal significantly more expensive for international buyers. That crushes foreign demand and forces the price down. This creates a rigid macro filter. If the US dollar index is breaking out to the upside, buying silver is a mathematically low probability trade. To synthesize all of these variables, institutional traders rely on one of the oldest indicators in commodities, the gold-silver ratio. This chart maps out that ratio over time. You calculate it simply by dividing the current price of gold by the current price of silver, which historically oscillates between a ratio of 40 and 100. If you watch the line dip down into the 40 to 50 range, the data is flashing a warning. It signals that silver has become historically expensive relative to gold, and a price pullback is highly likely. Conversely, when the ratio climbs above 85, it requires 85 ounces of silver to buy a single ounce of gold. This tells us silver is historically cheap, marking a high probability buying opportunity. By anchoring your charts with this macro ratio and tracking factory demand, you stop trading blindly. You transform XAGUSD's extreme volatility from a chaotic risk into a calculated, highly targeted trading instrument. You can test this strategy right now. Open an FXNX demo account today to practice calculating big point values and tracking the gold-silver ratio in a completely risk-free environment.